Brazen.
So I spent quite a bit of time in Allentown in Pennsylvania.
This is James Fontanella Kahn. He's the U.S. corporate finance and deals editor at the Financial Times in New York.
It's one of these towns was famous for its steel plants and its kind of tradition of kind of unionized steel workers, sense of real pride.
He picked this area because he knew a local plant was shutting down in the aftermath of a big merger between Kraft and Heinz.
Often as an M&A reporter, you're focusing on company A buys company B, good or bad for shareholders, and then you move on. It's like kind of do it again. Company A buys company B, blah, blah, blah. And I thought it was really important here to kind of get a sense of like how people on the ground got impacted by this. One of the people I spent a considerable amount of time was a guy called Rod Miller. At the time, he lost his job. And I remember walking with him. It was like snowing. We were freezing our asses. And we were kind of waiting to get into the local kind of job center. He was 61 years old. And he was telling me, James, I mean, like, what the hell am I going to do? I've been doing Italian and Russian dressings for most of my life. And even when I pressed him about, I heard that Amazon and FedEx are coming to town.
Mm-hmm.
Isn't that kind of good? And he was just like, kind of, I don't really believe in the system anymore.
This is The Closer, the inside story of the deals that changed the world. I'm Aimee Keane. There's an old mantra about running a corporation that's still taught in a lot of business schools today. It's the Milton Friedman idea that a company's primary role is to increase profits and to give those profits to its shareholders. This idea has been challenged in the last few years, with consumers demanding that corporations address things like environmental and social issues, and that they do so at the expense of the bottom line. But Friedman's philosophy still lingers in a lot of companies and corporate deals today. Perhaps nowhere more pronounced than with Brazilian private investment group 3G Capital and its takeover of two great American food brands, first Heinz and then Kraft. It squeezed out some of the widest profit margins in the U.S. food industry. That is, until the 3G way of business started to lose its shine. In this episode, we're talking about ketchup, pickles, and mac and cheese, and the costs of deal-making for a brand and the people behind it.
What I really found interesting, it brought together a number of elements that in many ways made it the perfect Financial Times story. The global aspect. So you have a Brazilian investment firm, you have the icon of American capitalism, you have iconic American brands that are consumed by everybody around the world. In many ways, it's the American soft power. Like ketchup probably has done more to expand American values than any president has.
Heinz is one of those iconic American brands.
Pickle lovers always insist on the proud pickle. Heinz, the way no other pickle does. Crisp, full-bodied.
Housewives every day pick up a tin of beans and say, beans means Heinz.
When will Johnny be back from going around the world?
What started in the 1860s after the Civil War as Henry John Heinz's horseradish bottling company became the brand synonymous with one of America's favorite condiments.
Heinz ketchup.
Oh, you noticed our Heinz. Here, taste it.
And as ad man Don Draper put it, Heinz was the essential ingredient in staple American meals.
It's clean, it's simple, and it's tantalizingly incomplete. What's missing? One thing. Pass the Heinz.
You mean the Heinz ketchup?
It's Heinz. It only means one thing.
Fast forward to 2008, more than 100 years after its founding, and Heinz was a multinational company doing $10 billion in annual sales. But by 2012, Heinz profits are under pressure. Expenses are up, as are prices on some of the raw ingredients that go into its products.
It had lost its mojo in many ways, in the sense that the products were a bit stale.
That's James again. In his role at the FT, he's been covering deals and deal makers in the US for the last 8 years.
A lot of these companies were run in a very inefficient way. Like, you had executives paying themselves huge bonuses. If you looked at it from a Wall Street investor perspective, they were very badly run companies with executives who didn't really care much about growing the brands. They just relied on these effectively fairly well-known brands.
This is where the private investment group 3G Capital gets interested.
They and other private equity firms found these consumer groups appetizing for the simple reason that there was a lot of fat that they could cut, effectively squeeze a good return out of these companies.
Private equity groups typically buy a company where they see efficiencies or ways to cut costs and then generate higher profits. And then they'll usually sell the company. 3G Capital, on the other hand, likes to refer to itself as private investment. And for them, the distinction comes down to how long they hold on to these companies.
So the one thing that you need to know about 3G, they never just buy one company to kind of fix it and flip it, which is what usually private equity firms do. And the idea is it becomes proof of concept. Like, we take over the company, we cut the fat, we turn it into the star in the industry. And the best way to do that often is precisely to take it off the public market. And by removing yourself from the market, you can actually do some of those tough decisions that are just easier to carry out when you're not public.
James, let's take a step back for a second and look at the origin story of 3G Capital. How does the private investment firm come to be?
You have Jorge Paulo Leman, who is very much kind of the man behind 3G.
Leman was born in 1939 in Rio de Janeiro, but both of his parents had ties to Switzerland.
He's definitely an extremely private person. What we do know is he is a former professional tennis player. He's an old world kind of financier, not flashy, who has cultivated incredible contacts with some of the wealthiest families around the globe.
He worked at Credit Suisse in Geneva and a few other lenders. And then, in 1971, with 2 business partners, he started his own investment firm. It was called Banco Garantia.
Many people kind of say it was the Goldman of Brazil.
The firm was acquired by Credit Suisse in 1998, and then Leman made his next move. He and his partner started building a portfolio of investments as 3G Capital, which stood for the 3 Brazilians who once owned Garantia. Leman & Co. had acquired the Brazilian beer company Brahma a few years earlier, and they used it to buy more beer brands. Here's how it went. Brahma acquired rival Antarctica to create Ambev. Then, in 2004, Ambev acquired Interbrew and created the world's largest beer company. It was called InBev. And then, in 2008, InBev bought Anheuser-Busch, creating the beer giant AB InBev.
That kind of turns them, in the span of very few years, into the largest beer company on the planet. Effectively, every time you walk into a deli or a supermarket, pretty much in the beer area, like probably more than 50% of the beers you see on the shelf are owned by a 3G-backed beer company.
As 3G built its empire, the investment group became known as one of the best at running consumer companies.
The CEO of that company for the longest time was Carlos Brito, who was handpicked by 3G and really kind of installed the 3G way in the way that the beer companies were run.
The 3G way. This was a management approach that went far beyond beer.
The lean and mean, so to speak, method is also known as the zero-based budgeting.
Isn't that a thrilling line?
Yes. And it's kind of revolutionary in many ways, in the sense of they effectively get rid of everything which is in excess.
And by everything, we're talking about everything. Individual people, entire departments, buildings, right down to office supplies. all driven by this idea called zero-based budgeting.
The zero-based budgeting method is like, you don't have a budget. Like, the idea is like, you want something, you'd need to make a case for it.
Another aspect of the 3G way is strict control over its people.
Your performance is measured in ways that, in fairness, very few other companies ever did. And critics say it's slightly kind of, it's anxiety driving. Like, it causes a lot of fear into people. From 3G's perspective, it's just like, they'd say that they believe in ruthless meritocracy. I mean, in many ways, they kind of represent the opposite of everything you'd think about Brazil, which is about color, it's about joy, it's much more Swiss, if you want. Again, I'm probably going to get criticized for making stereotypes of people, but as a lover of Brazil, I think I'd celebrate its kind of sense of joy. Yeah, I think Lehman doesn't really transmit a sense of joy. It's that sense of like nearly monasterial kind of austerity. And again, it's like, this is one of the richest human beings on the planet.
So in the fall of 2012, as Heinz profit margins are coming under pressure, Lehman and 3G set their sights on the food company. They'll take over, cut costs, and use it to roll up other notable consumer companies. 3G has a method and a plan, but it doesn't have the cash or the name recognition in the U.S. So it turns to who it thinks is the ideal partner.
Joining us right now on the Squawk Newsline is Warren Buffett, of course, the chairman and CEO of Berkshire Hathaway. Warren, thank you for calling in this morning.
They found somebody that would help them sell the idea of, we're buying this kind of company, which is like really kind of in the heart and souls of many Americans, but along us, don't be scared. We're friendly. We also have Warren Buffett with us. And so that kind of, I think, helped a lot, reassuring people these Brazilians were to be trusted.
Georgie Paulo Lemon, who runs 3G, talked to me about early December. We were on a plane together, and I've got a file on Heinz that goes back to 1980, but he is the one that got me going on this in early December.
And
so at the heart of the relationship between Buffett and Lehman is a shared view that they want to pick the best management teams to run companies. So he saw in Lehman a partner that he could trust, that had the same philosophy. And the other thing that Buffett loves, which is also kind of loved by the 3G folks, is precisely investing in well-known consumer brands, in brands that kind of resonate with the public.
It's our kind of company. It's got a group of fantastic brands led by Ketchup, and the company started in 1869 with horse.
The deal's officially announced on Valentine's Day of 2013. Here's the then CEO of Heinz, William Johnson.
Heinz has entered into a definitive agreement to be acquired by an investment group led by Berkshire Hathaway and 3G Capital. Upon closing of this unprecedented transaction, Heinz will become a private enterprise. At $28 billion, this will be the largest acquisition of any company in the history of the food business.
Both Berkshire Hathaway and 3G invest in the deal, but Buffett puts up some extra money to finance the takeover. Meanwhile, 3G takes over operations, and once the deal closes, quickly gets to work putting its mark on Heinz.
So the first few things is change the management, kind of put their own people in charge.
And then it's time to clean up operations.
The number one focus is how do we boost margins? And often it's by shedding products that are not really popular anymore, closing down factories that are not really as productive as they should be. So there's a really aggressive focus on seeking so-called efficiencies.
There's that word efficiencies again, the great business jargon that's usually code for cost cutting in order to boost margins. It goes all the way back to Milton Friedman's idea of shareholder primacy. And it's a big part of this 3G method of running companies.
In their case, they're preparing the company to then become the blueprint to buy the next company. And that's kind of what they were good at. What they kind of knew is also to be successful in any sector, you need scale. And so the idea is immediately after they complete that deal, they have a group of people, again, mostly very young analysts in New York, scouting for the next asset. They're looking for the kind of brands that they think are successful, or some brands that they think that they can turn around by boosting their margins effectively. Wherever they'll be spending a lot of time doing a lot of research, looking at if studying the number of trucks that are going in and out of a factory, looking at the quality of the products, how they're packaged. It's a very meticulous kind of analysis, and then a lot of financial analysis. They're great financial engineers. That's part of what they do. That's kind of their special sauce.
Tell us what they land on.
They land on Kraft.
Kraft Foods and Heinz tying the knot. Kraft Foods and H.J. Heinz have agreed to a merger.
I mean, you think about your refrigerator, everything from Oscar Mayer, Heinz, Philadelphia, now all in one company.
Yeah, it's amazing. And the brands are iconic American brands.
They include products like Maxwell House Coffee, the Velveeta cheese range.
They say they will create the third largest food and beverage company in North America.
And the man putting the icing on this mega merger, well, none other than legendary investor Warren Buffett.
Buffett and his partners at 3G Capital. All told, through Heinz, the two investors pick up Kraft at a value of nearly $63 billion.
For a private capital firm to pull off a $60+ billion deal, that's kind of insane. None of these deals would have happened without Buffett. I think that's kind of important to understand, that Buffett was instrumental both from a point of kind of legitimacy and kind of bringing that kind of cachet that Buffett has, but also in the sense of bringing the cash.
Yeah, the cachet and the cash.
Yes.
This deal's announced in 2015, and after it closes, 3G once again gets to work trimming the excess it sees at Kraft. The combined company only needs one CEO, and they install one of their own guys, Bernardo Hess, in the top job. There are other cuts to be made, too. For example, 2 HR teams can become 1. Fewer factories are needed to make the products. That means job cuts, buildings shut down.
The idea is do not waste. And in a nearly kind of, in a religious way, without interfering on any particular religion, but the idea of waste was seen as sinful.
From the time 3G takes over Heinz and later Kraft, up until 2017, a fifth of the workers are laid off, and 7 plants are shut. This translates into huge profits for the company and its investors.
They had the highest margin than any other consumer company by a lot.
And how did investors react to that?
Investors loved that. I mean, it was by far the darling of the investor community. Everybody wanted, if you were invested in another consumer company, they'd tell you, you need to copy those guys.
Mm-hmm. So if we go back to the model that you explained 3G brings to its platforms, it started with Heinz, then it picks up Kraft. I think listeners paying attention will know that maybe there's another company out there that they're going to try to add to this platform. Can you tell us what they tried to go after next and what happened?
So the next big target for the now newly formed Kraft Heinz is Unilever. It's a shocker.
At the time, Unilever is one of the largest consumer goods companies in the world, with a radically different corporate culture than 3G brought to its companies. So when the Kraft Heinz CEO, a 3G guy, approaches the Anglo-Dutch group, it ruffles more than a few feathers.
What happens in that split moment is you start seeing some cracks.
We'll be back after the break. We're back to our conversation with James Fontanella-Kahn from the Financial Times. James and his team break the news that Kraft Heinz is pursuing Unilever.
Kraft Heinz is hungry for a deal, a big one worth more than $140 billion. The food conglomerate, backed by billionaire Warren Buffett and the Brazilian private equity firm 3G, made a takeover offer for Unilever in what would be one of the biggest deals ever. But Unilever said, hold the mayo.
From a kind of cultural perspective, they were two very different kind of companies. Unilever embodied, under its then chief executive, a lot of the values that you have of kind of being a more gentle form of capitalism, which was kind of perfect for 3G in many ways because they could see a lot of fat and stuff that they could do to kind of improve the company. When the FT revealed that like Unilever was 3G's next target, it kind of shocked everybody. We kind of probably killed the deal. They were really not okay with 3G taking them over.
3G's ambitions to take over Unilever start to look like a hostile bid. And, as the name suggests, a hostile bid or a hostile takeover can turn into a battle pretty fast. It may start with a friendly meeting where the acquiring company makes an informal offer to the target company. But if the board and management say no, this is where it can turn hostile. The acquiring company, in this case Kraft Heinz, could go right to the shareholders and present their offer. Then it's up to the investors.
And so you have a pretty ugly but brief public debate about should these evil kind of cost-cutting investors come and take the lovey-dovey Unilever and this kind of European consumer champion. And obviously the story isn't that, I think we shouldn't over-exaggerate that Unilever is this kind of angel and that 3G are the bad guys. It just didn't work. I think in hindsight, it was in the best interest of both companies that deal didn't go through. Unilever, it was a $147 billion deal. I mean, that's gigantic.
Kraft Heinz never does launch a full, formal, hostile bid for Unilever. It agrees to withdraw its bid shortly after James's story breaks.
It was incredibly embarrassing, I think, for 3G. They're not used to failing. And
was this embarrassing for Lehman?
We don't know that for sure, but according to people we spoke to at the time, yes, he was not happy. But what made it more painful and more embarrassing was that Warren Buffett came out saying that he was not okay with a hostile bid.
This is based on James's reporting, and he says it spells the beginning of the end of the warm relationship between 3G and Berkshire Hathaway.
Do you fundamentally disagree with the combative nature of hostile bids?
I don't think it's evil or anything to conduct a hostile offer for a company. It's just we won't do it.
What did you make of Buffett's reaction?
So Warren Buffett, who again embodies an old school form of capitalism, he only does friendly deals. He's not a barbarian at the gates kind of guy, as often kind of private equity folks are referred to. One wonders whether that was a convenient move by Buffett. I mean, he was on the board at the time, so did he really not know that this was going on? Maybe. Buffett cares a lot about his image. He's a shrewd investor.
The failed attempt for Unilever happens in February of 2017, and it kicks off a series of difficult moments for 3G. To start, the same quarter that the Unilever deal fails, Kraft Heinz earnings miss investors' expectations, and the share price falls. Then, the following year, in 2018, Buffett announces he's stepping down from the Kraft Heinz board.
We do have some breaking news on Warren Buffett this morning. He is denying reports of tensions between him and 3G Capital, which is the company's partner in Kraft Heinz. Buffett said 3G co-founder Georgie Paulo Lehman is a good friend and said that he plans to see Lehman next month at Allen & Company's Sun Valley conference. These reports had been out about tensions between them, but Buffett also expressed support for the incoming CEO.
And just a couple months later, another crack in the 3G armor.
So we're in 2018, we're at the Milken Conference in LA, which is kind of the Davos on the west coast of America.
It's a big conference for people who invest private money. Private equity, private credit, family offices.
Like, if you want to know what Wall Street is thinking, that's where they kind of decamp for a week or so.
And it's run by none other than Michael Milken, who's perhaps best known for being indicted for violating U.S. securities laws during the junk bond boom of the 80s, and later being granted clemency by Donald Trump.
Since then, Milken has kind of refashioned himself as this conveyor of great minds in the world of finance. So the people you meet there are mainly male, mainly white, financiers.
Georgie Paulo Lehman is there for a rare public appearance.
In beer, we had the new kinds of beers coming in all over.
He's on a panel discussing leadership in the age of disruption.
Georgie, I'd like to turn to you, if I could, please. The industries that you have invested in that I'm most familiar with are old line, consumer-focused industries, beer.
It's a moment. And he comes out with this line where he says, he admits fundamentally that he's not perfect. And more importantly, like, he's not infallible, like something that investors had really looked up to him for so long. And he says,
terrified dinosaur?
I'm a terrified dinosaur.
Especially after attending this meeting. I went to a food meeting yesterday, and all they talked about was new products and new forms of producing food. And I go to the next meeting is an artificial...
Effectively, what he admits is that he was the one that was disrupted. Like, he kind of had failed to see where the world was changing. To some extent, you could argue that buying Unilever was a way to address some of the things that were changing in the world, that the fact that you had to invest a bit more in your brands, the fact that you had to kind of think about the broader kind of environmental, social, and governmental impact of what your companies did, and just kind of being more attuned to what was going on in society.
Was that surprising?
It definitely was surprising. When you don't speak that often, every word that you then say publicly counts. And it was kind of humbling, to be honest. It kind of proved that somebody had been incredibly successful for so long was admitting that they needed to change. And following the failed acquisition of Unilever, Kraft Heinz goes through a pretty tough spell. It's struggling. For the first time, the masters of turning around consumer companies are not doing that great.
Then, the following year, Kraft Heinz leadership has some bad news to share with investors.
At this time, I would like to welcome everyone to the Kraft Heinz Company's fourth quarter 2018 earnings conference call.
I think it's the trifecta of bad news. They had a write-down. I think it was effectively they wrote down their deal. It was a $15 billion write-down. An accounting scandal. And they had to cut their dividend. So it's like Armageddon.
An analyst from JP Morgan's on the call, and he sums it up like this.
So when investors are looking at, the consistent financial disappointments at Kraft, and if they ask why, if the 3G belt tightening strategy goes too far, and if it damages brands, isn't at least some evidence starting to point to yes there? I'm just curious for your thoughts on that.
To which CEO Bernardo Hess says,
look, we still believe in strongly that our model is working and has a lot of potential for the future, right?
But it's not enough to calm investors. The stock drops again.
And then I think a few days later, Buffett comes out to kind of the cherry on top of it all, saying that, he thinks he's overpaid for the acquisition of Kraft.
I was wrong in a couple ways on Kraft Heinz. And then we overpaid for Kraft, and we wrote down $15 billion of that.
Buffett telling the market that he had overpaid was pretty damaging for 3G because, remember, back in 2010, they're really seen as the best guys at operating a consumer group. You might not like their ways, you might think they're too brutal, this and that, but they're good. They're really good at what they do. And fast forward to 2019, that shine has just come off. I think that was probably the lowest point for 3G after having had a pretty phenomenal run. And it kind of forced the company to reconsider some of the kind of its mantras.
This starts with a new CEO at Kraft Heinz. 3G puts the former AB InBev chief marketing officer in the top job. His name's Miguel Patricio.
Patricio kind of really pivots the company on innovation, on kind of being more of a global brand, a fresher brand, a more modern brand. They shed a lot of assets that, again, are not really kind of core to the brand. What weirdly helped them a lot was the pandemic in many ways.
COVID lockdowns and quarantines mean that dry, packaged foods that could last a long time are all of a sudden in high demand. At one point in 2020, Kraft Heinz quarterly sales increased more than they had since the two companies were combined.
It might sound cheesy, but like mac and cheese became, who cares about putting on a few kilos?
It's comfort.
It was comfort food, yeah.
The pandemic offers a boost to the bottom line, but investors' appetite for Kraft Heinz today is nowhere near where it was just a few years ago. The stock is a fraction of the value it was when the companies merged. Meanwhile, Lehman, who's now in his 80s, has stepped down from the board. As for these iconic American brands themselves,
they were truly global. If you grew up in San Martino Sicomario, like about an hour from Milan, as I did, in a small village, you still found ketchup, you still found le sottilette Kraft. Like, these are, we had Italian words for those products. And like, so yeah, these were like global, phenomenally global brands. And I think the question was, consumers globally have changed. And the lesson there is like, if you need to be capable of pivoting constantly. Everybody always talked about a playbook. There is no playbook. There is a constant like shifting of tastes.
There's changing consumer taste for the products, but it's not just about the product. It's also about the way these brands and companies are managed when a group like 3G Capital takes over.
The company doesn't take care of the people. The company takes care of shareholders who own the company. And so the basic idea behind that is the company needs to do everything possible to maximize profit. If that means shutting down a plant, you shut down the plant.
This takes us back to Allentown, Pennsylvania, where Kraft Heinz shut down one of its plants after the merger, and to Rod Miller, who James caught up with. Rod told James that he and other workers were already facing fewer shifts and layoffs before news of the deal.
It was an industry in crisis.
But when Rod and his fellow workers heard about the deal and that Warren Buffett was part of it, they thought it would be good news for their jobs.
They thought, oh, Warren Buffett is going to come in, he's going to save us. It turned out not to be like that. It turned out that Warren Buffett is a very good capitalist, and like any good capitalist, he wants to make money. And if it comes at cutting jobs, he will go down that route. And I think that's what kind of touched me the most, was the fact that like Rod was at the end of his kind of career, and he felt like he had been stripped of his dignity in many ways. But he felt like, the final years of my life, I'm going to be doing some shitty job. And this is not about blaming 3G, or it's the capitalist society we live in, and the impact it has on the lives of people like Rod Miller, who got laid off at that plant. And the conflict here is like, these guys are really good at making money, but the cost of their success is coming to the expense of somebody else. And so how do you reconcile that? And in hindsight, I feel like, again, what is our role as journalists? You tell the story, you try not to take a side, you try to just expose the conflict so that it becomes clear to people. And I think, did that story change the course of like the debate around kind of maximizing shareholder value? Absolutely not. But was it a little kind of chip at the idea that like shareholder value maximization is the ultimate religion that we should live by? I think it did chip it. It contributed to a broader discussion about what kind of capitalism do we want? Do we want the most rapacious one? Or do we want a capitalist society where actually more people are lifted out of a situation, or maybe have the chance to move up in life? And so that is the reason why I thought what appeared just as a simple A buys B kind of story had much more to it for the very nature of the actors involved.
That's it for this week. Thanks for listening. If you like this episode, would you please leave us a review on Apple Podcasts, or better yet, share the show with someone who might enjoy it, and hit that subscribe button so you'll know every time we have a new episode. We've been asking you to send us your best deal stories, and now we have a new question for you. What's the most underrated deal in M&A history? Maybe it's one you followed really closely that's been forgotten in the last few years, or maybe it just didn't get much coverage at the time. You know how this works. Send us a voice memo with your first name and where you're from, And then in just a few sentences, tell us what the deal was and why you think it matters. You can email your audio file to hello@thecloser.fm. We'll review all the submissions, and we just might play yours on a future episode. Now, if you want more from The Closer, we have the newsletter for you. Go to closer.fm to sign up. It's written by journalist and Closer producer Ben Walsh, and it's witty, informative, and the place where he's going to dive into the mechanics of M&A and analyze deals in the news. You'll get a chance to see show notes from each episode and much more from our team. So just sign up at closer.fm. And if all of this isn't enough, you can also become a Brazen Plus subscriber on Apple Podcasts for exclusive access to extended interviews and other bonus material from the show. The Closer is a production of Project Brazen in partnership with PRX. Our show's produced by Isabel Kirby-McGowan and Ben Walsh. Siddhartha Mahanta is our editor, Mariangel Gonzalez is our project manager, and Lucy Woods is our fact-checker and head of research. Golda Arthur is our showrunner, and Bradley Hope and Tom Wright are executive producers. At Project Brazen, Francesca Gilardi Quadrio Curzio and Noor Abdel Latif are podcast strategists, Megan Dean is programming manager, and Ryan Ho is design lead. Thanks to Eric Gomez for audio engineering and sound design. Our composers, Alex Garcia Amat. I'm Aimee Keane. Thanks for listening.